Let's be very clear from the start, this is not a political forecast. It is an analysis of capital positioning. You see, beneath the surface of the daily market noise, a very significant and quiet repositioning is already underway. To really understand the implications, especially for an economy like India's, we have to adopt an institutional perspective. So, we're going to deconstruct the patterns of previous market shocks, not to predict the future, but to understand the playbook that sophisticated capital always uses when it anticipates disruption. To understand what might be coming, we have to look back. Think about the last major, truly unexpected policy shock that hit the Indian market, the 2016 demonetization. It was sudden, it was disruptive, and it was designed as a total system reset. The market's reaction wasn't just fast, it was a perfect case study in how retail sentiment and institutional strategy can move in completely opposite directions. In the immediate aftermath, you saw the most visible and liquid assets take the biggest hit. Precious metals and silver in particular, which is often a proxy for retail sentiment in India. Well, it experienced a sharp, aggressive sell-off. It happened in just a matter of days. The story you heard everywhere, amplified by the media, was one of widespread, indiscriminate panic. It really looks like the foundations were cracked. And that narrative, of course, became a self-fulfilling prophecy. Retail investors, reacting directly to those alarming headlines and just the sheer speed of the price drop, started dumping their positions. We're talking about huge numbers. This wasn't some calculated de-risking strategy. It was pure capitulation, driven by fear, and it injected a massive wave of liquidity into the market. But see, under the surface of all that retail panic, something else was happening. A very different transaction was taking place. Institutional capital, which operates on a much longer time horizon and with a deeper level of analysis, began to quietly absorb all of that selling pressure. They saw a critical dislocation. The emotional, headline-driven story was completely disconnected from the underlying structural reality. The fundamental drivers for demand hadn't just vanished overnight. This wasn't a structural crisis, it was a liquidity event. And for them, that's a significant opportunity. So today, we're facing a macro-political variable that is potentially much, much bigger. The prospect of a second Trump administration. The implications are global, of course, but the exposure for India is especially acute, just given its unique position in global trade and capital flows. The market right now seems calm, almost complacent, but that kind of stability often masks the deep underlying preparation for volatility. So to really assess the risk here, we have to look past the political talk and focus on the one unambiguous signal we have: the movement of capital. Politics creates headlines and debates, but money flow reveals actual positioning. It's the footprint of thousands of institutional decisions being made right now in anticipation of what's to come. And when we talk about money flow analysis, we're not just tracking stock prices, we're tracking the allocation of significant capital, where it's going, where it's being de-risked, and where it's being hedged. This kind of movement, which often happens in the deep, opaque corners of the options and derivatives markets, it frequently happens well before any catalyst becomes public knowledge. It's really the closest thing we have to a leading indicator of true institutional sentiment. You have to understand, sophisticated capital doesn't wait for an official announcement to react. It operates on probabilities. It anticipates a whole range of potential outcomes, and it preemptively repositions portfolios to be resilient against the most disruptive ones. And that's why the biggest, most significant market moves are often the quietest ones, that gradual accumulation of defensive positions that happens weeks or even months before the event itself. Now, history doesn't repeat itself perfectly, we know that, but patterns of market behavior, the core psychology of fear and greed, they absolutely do. So by examining the anatomy of that last shockwave, we can identify a playbook, a sequence of events and reactions that might just be unfolding once again, even if the circumstances are different. This sequence from that 2016 precedent was clinically clear. It started with a trigger, an unexpected top-down policy announcement. This immediately hit a key commodity, which led to a sharp sell-off. The effect was a surge in market volatility, which was then amplified by the media, creating this feedback loop of fear. That led to the reaction. Retail investors capitulated, selling right into the panic. And finally, you had the response. This wave of selling provided the exact liquidity that institutions needed to re-enter and reposition their portfolios at much better prices. The crucial difference for institutional desks was the nature of the sell-off. While the price action looked severe, the underlying data told a different story. Key metrics, things like institutional ETF flows and data on physical demand, they just didn't signal a structural collapse. A structural collapse would have meant the asset itself was fundamentally impaired. But this was an emotional, headline-driven event.
and markets can absorb emotional shocks much faster and more predictably than they can a fundamental structural shift in the system. The risk that's being quietly priced in right now by institutional players isn't just one single event. It's not about one policy or one speech. It's what we call a threat cluster, a network of interconnected possibilities, a whole set of potential friction points that could be introduced into the global system all at once. So the market isn't watching for one specific action, but for a potential shift in doctrine. This includes the rhetoric around escalating trade disputes, the strategic use of tariffs, not just as a tool, but as a primary weapon, new tools designed to pressure currencies, and a much harder stance on the global supply chains that took decades to build. Each one of these, on its own, is a point of friction. Together, they represent a potential paradigm shift. Now, while these are global themes, their impact is not going to be distributed evenly. The transmission mechanism, the way these macro pressures actually translate into real economic effects, makes India particularly sensitive to this specific cluster of threats. We really need to understand its unique points of exposure. India's economy isn't structurally weak, but it does have specific acute exposures. Its high dependency on imported energy and key industrial metals means any disruption to global trade translates directly and immediately into domestic cost pressure. At the same time, a global risk-off event, which a shift in U.S. trade policy would definitely trigger, typically leads to a stronger U.S. dollar. This puts direct pressure on the rupee, and that in turn makes foreign institutional investors, the FIIs, much more cautious. They might not sell what they already hold, but even just a pause in new money coming in is enough to drain liquidity and hit valuations. So the primary risk being modeled by institutional desks is not an outright market crash. It's the introduction of systemic friction. Think slower trade, higher transaction costs, a pervasive increase in policy uncertainty. You see, modern financial markets are built on the assumption of efficiency, speed, and predictability. Friction is the exact opposite of that. It gums up the gears of the entire system. To really understand the current environment, you need a critical skill: the ability to separate the high-frequency noise of daily news from the low-frequency signal coming from institutional capital. They are listening to two very, very different things. The institutional approach isn't about predicting the future with certainty. It's about preparing for multiple potential futures. The central question isn't one of prediction, it's one of preparation. It's not, will this happen? It is, if it does happen, where do we need to have capital parked to withstand the initial shock? The entire focus shifts away from forecasting and towards building portfolios that can absorb a major volatility event. And the signals of this quiet preparation are subtle, but they're clear if you know where to look. First, a rising preference for short-term cash and cash equivalents, a clear move to safety and liquidity. Second, you see specific targeted hedges in commodity markets to protect against supply chain shocks. Third, a quiet but steady buildup of defensive long dollar positions, anticipating a flight to quality. And finally, a noticeable reduction in the pace of aggressive new money going into emerging markets like India. This isn't panic selling, it's a calculated, methodical rebalancing. And this really reveals the fundamental split in focus. The retail focus is captured by the immediate high-volume narrative, the tweet, the breaking news headline, the daily price change. The institutional focus is much deeper, quieter. It's centered on abstract but critical factors: the state of market liquidity, the speed at which they can change strategy, and the second and third order effects of a major policy shift. The ripples, not just the splash. The most significant shifts in financial markets are rarely loud or dramatic when they start. They're quiet, they're gradual, and they're largely invisible to the undiscerning eye. This is the nature of the invisible shift, a quiet warning that is being issued right now by the flow of capital. There's a saying in institutional circles: sudden moves aren't sudden. They're just invisible until they aren't. By the time a major repricing event becomes obvious to everyone, the real positioning has already happened. The final, sharp price action feels sudden, it feels shocking, but the capital flows that drove it were methodical and deliberate, building up pressure under the surface for weeks, even months. The current market environment shows a particularly dangerous combination of factors. Implied volatility across major asset classes is low, which suggests a deep sense of complacency. The news cycle is relatively quiet on these specific risks, distracted by other stories, and the surface of the market, it looks remarkably stable. This is precisely the kind of environment, a calm surface with immense pressure building below, that historically comes right before a sudden and sharp repricing event. This analysis, in the end, is not a prediction of a specific outcome. It's an observation of a recurring pattern in market behavior. And it leaves us with one critical question. When the market narrative is one of calm and the surface looks placid, the only thing that really matters is this: who is using this quiet period to methodically prepare, and who is being lulled into a dangerous state of distraction?